got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So hello, everyone, it's Hardy and I'm back for another video and I hope you guys are having a good time and welcome to my channel. How are you guys doing? Guys, we are on the matter of option trading and trying to break down option trading in the best way I can, and thanks to Webull. Webull has given me notes that I can use as a reference and I'll post it here so you guys can see. So let's talk about a long call option. Like I said, when you pick up a call, you have the idea that the stock will go up. When you put down the phone, you have the idea that the stock will keep going down. Okay, you can buy a put or sell a put, and you can buy a call or sell a call. So in today's video, we'll be talking about long call option. Okay, when it comes to long call option, it entails a call option by itself. That means you don't really have to have 100 shares of the stock, okay, when you do a long call option by itself. Investors with an investment objective of growth, that this is when you feel, okay, this stock would go up. I bought this stock at, let's say, $10, right? Now I want this stock, I feel this stock will go to $12 someday, so I will put a strike price for $12, and that when it gets to, so a call option gives the investor the right to buy a stock at a particular price. So if a stock is low and people are like, oh no, this stock is bullshit, I'm like, I think this stock will get to $15, $20, but I would put a strike price at $12 as the buyer. Like, hey, at $12 I am willing to buy this stock from you that you got at $5, okay? Now if it gets there, then I'll buy, but if it doesn't get there, then kudos to you, okay? And it's for a specified time period. Now the call option gives the investor the flexibility to purchase the stock at a later point in time if it does appreciate in value. Now the person who sells to me, right, when it gets to $12, they will sell it off to me. Now I would have paid a premium to them, so they would receive a premium. Now if this stock gets to that point, they will keep the premium, but the stock now becomes mine, and any future growth on that stock will be mine, okay?
We're gonna get into some technicalities here because you know they always gotta come with the receipt.
For this, the investor pays a premium, which is me, right? I am now paying a premium to the seller, telling them for a call option because I believe the stock would go up. Okay, so I'll buy the right to buy 100 shares at that higher price, provided I know that it will go beyond that, okay? But that person is like, I don't think so, the person who sells. So while there is a theoretical infinite upside potential in purchasing a long call option, the investor stands to lose the entire amount invested in the long call option strategy before or by the expiration date if the underlying stock underperforms. So what happens now is that if it doesn't get to that $12, the seller keeps the premium. So a long call option strategy therefore requires a considerable level of risk tolerance. An investor who has a bullish outlook, bullish is when someone is like, yes, I believe this stock would grow, okay? Outlook that anticipates the stock price to rise beyond a certain price. See what I said there? By a particular date. All option trades have a expiration date, okay, to utilize the call option. So the date expires at the day on, so you can buy that stock from them on or before. Okay, so on the last day or before, but you have to do it before 4 p.m.
Period.
Now, example would be an investor anticipates that the stock A will go up in the next 3 months. So the stock A trades at $10 right now. Now they bought a 3-month call option with a $10 strike price. Now the investor buys one call option of stock A at $10, which represents 100 shares. A contract represents 100 shares of a stock within 3 months. Now they pay $2. That $2 is the premium that goes to the seller of these contracts. Okay, the maximum potential profit is infinite because that stock can continue to rise and rise and rise. Okay, now the maximum profit would be the increase minus the call option strike price, which is $10, right, times 100. So that would be the way you can calculate the profit. The maximum potential loss would be the premium paid for the 100 shares. So it would be maximum loss per option would be equal to the premium paid times 100 shares. So it would be $200 worth of loss because the premium, they would keep it, right? And that's times 200. That's how you make this loss. Okay, don't keep the premium because hello, the stock never got to that point. So the seller wants this stock to stay in the money. You, the buyer, want the stock to be out the money. Okay, OTM. So the break-even point would be the $10 strike price. Now the break-even is the option plus the $2 premium of the paid value, premium paid. Now this $2 is $2. Most times it's the premiums can be like 0.1 or 0.2, but they multiply it into 100 to give you this $2. Okay, now the break-even point would be the strike price, which is $10 plus the premium of $2. So each of that stock will now be worth $12. Are you seeing that? Yes. So when you see that $2, it's like, oh my god, no, that is multiplied. That will be multiplied by 100. Okay,
we are going to pretend we didn't hear that. Let's move on.
So let's look at this graph. The break, remember the strike price is 10, right? Now I who sold this call, my goal is that please don't, get to $10, because if it gets to $10, the person who bought the call would take my shares from me, and the rest of the profits that comes to this goes to that person, not me. Okay, so if stock A trades at $12 and beyond for a long call, all these profits would go to the investor. Perfect. So in other words, the maximum potential loss will be 200. So if the strike price is not achieved, the person who invested in this option would lose that 200 premium paid to the seller. But if the strike price is achieved, it's now added to the cost price of me who invested in the stock.
This ain't no allegedly.
So now the person who buys the call, right, can purchase these stocks at $10 a share. They can exercise the option at any time the stock trades above $10. However, the person who does that can break even on the call option if the price of stock A breaks 12. So if by the expiration date the price of the stock is above $10, then there is enough equity in the investor's account to exercise this call option. Therefore, I who bought the call, if that stock price gets to that $10, because I believe that the stock will get there, I should have enough money in my buying power to then buy the stock at $10 from that person. and now any other profit or growth on that stock belongs to me. So they will just keep this stock now, but the premium, sorry, you know, so if by expiration date the price is above $10 and there is not enough equity in the investor's account to exercise the call option, this option will be automatically exercised, which means resulting in 100 shares long of stock A at $10 as the next day. So if you're like, oh my god, I actually bought this call, now it's now at $10, but I don't have the money to buy it, Webull would would make sure it goes through, and you have to pay for it whether you like it or not. They literally can take your stock, like they'll tell you to sell positions, else you have what we call AGV. It's like a warning, like you've messed up. So for the next 12 months you're fucked, you're on thin ice and you can lose your account. Okay, that's when they're like, don't sell or don't buy above margin, because you can lose so much money in those situations.
I got chills, then multiply.
So you have to be very, very careful. So if you don't have enough equity to purchase these shares, you can instead sell the call option before the expiration date at a profit, so you can give back. Yeah, you see. So if you wanted to hold on to it, sorry, you can either give it back by selling. So the good news is that before the expiration date, Webull will always give you a warning, like, hey, just so you know, this call option you bought is about to expire, so you either buy now or you have to sell, because someone else will be interested in the call option. So if the stock price of A fails to stay above $10 by expiration date, the call option will eventually expire, you see, and the investor loses the entire premium that was invested. So you have to be careful. I hope this was broken down in the best way possible. Now the chart, as you can see, the chart is the best way to explain this. If I buy a call from someone at a $10 strike price, because I believe that this stock will go even further, now that person is willing to sell at that price at $10. That is strike price. Okay, now I have bought this at $10. When it gets to $10, it's time for me to pay up. If I don't pay up, I have to sell it off, because if I don't, I'm in trouble.
The orders are on their way.
By which time I shall be gone, and you shall be dead.
So I have to have enough buying power to even brag, like, yeah, I'm sure that this stock would go up even further. Now when it gets to that price, I'll have to buy that call. I'll have to buy other stocks at that price. Meanwhile, this stock used to be maybe $6, but I believe this stock would go to $10, $11, $12. So I'm like, okay, at $10, if it gets to $10, I'll buy these stocks from you, and if it goes further, I'm keeping that. Okay, you, the seller, decided, okay, yes, let's shake on it, you know. So any future profits, if it gets to $10 and I get the stock to myself, I have to now pay for the stock at that $10 that I bragged about. So any future profits is mine. Now I have already paid the premium. If this price does not get to that $10, I would lose that premium I paid to the seller. That's the best way to put it. I hope this worked so well for you guys, because now it worked for me too. I'll see you guys soon in the next video for Saudi and DAWSON Studios. Please let me know if you got it. If you didn't get it, put your comments in and I'll be able to respond to you guys. Okay, I love you all so much, and my strategy is I love buying puts and I love selling calls. Okay, I'll see you guys soon in the next video. Until next time, bye guys.
Ooh wee, look what that money make a bitch do.
Cause I'm loving myself real good. Did you guys hear that? I'm scared. In a way that you